our COBT listeners and viewers, it's Maynard, Mike, and Deborah Byers, our senior advisor, one of our senior advisors here at Veriten. We're thrilled today to be visiting with Jim Murchie. He's the co-founder, co-portfolio manager, and CEO of Energy Income Partners. Jim's an old friend as well. We've known him from his research days, from his investing days. I also have a particularly soft spot because he is a rice owl, and we always love having rice owls on the show. Jim, welcome. We're excited to talk to you about power systems, power prices, power dynamics, all the power variables we can think of. Welcome.
Thanks for having me, folks.
We're excited. Well, Mike, it was probably a boring day today. You probably don't even have anything to talk about.
No, as usual.
You thought
I have nothing to talk about.
Okay.
So we can just move on, right?
Okay, great. Okay. Thanks, Mike.
All right.
Okay.
Seriously, you probably haven't heard me say this before, but the word volatility, right? As I kind of think about the markets so far this year, and actually today, it's volatility. And about the only thing that isn't volatile right now, it's probably the least volatile asset class is a 10-year bond. It's just stuck at 4.25%. It's not going anywhere. But if you look at just, just commodities in general, commodities, be it oil, gas, copper, gold, silver, Bitcoin. I mean, the volatility so far this year is just remarkable. I mean, you've got basically Bitcoin down 15% here year to date. And so, everyone that thought this was a perceived store of value, I guess that's being taken out to the woodshed right now. But anyway, the volatility in these areas is quite remarkable. And I think that's a key thing that we're seeing in the markets. As far as crude oil, we're around $63, $64 a barrel. We were down to $55, $56 a barrel not many weeks ago, and we got to around 65, 66 late last week, and now we're back here. And a lot of that was just, sort of these Iranian tensions. And so there's nothing really fundamentally changed in the market. The only thing that's fundamental in the market is you got a massive short position in crude oil contracts right now. And so every time you see something positive that people get concerned with, oil coming off the markets, you get a squeeze. That's what we're seeing. Oil's volatile, but it's really not making any headway in any direction. And so I think that's the news there. From a natural gas volatility standpoint, I mean, the amount of volatility we've seen over the last 2 weeks is just remarkable. It reminds me back, in my Enron days, to be quite honest with you, you've had gas go from $3 an M to almost $7 an M. Now we're back down to $3.30 an M on the March contract. That's off about $1 over the last couple of days. And so obviously it's because of the winter outlook, but also people are starting to think about, okay, where's the withdrawal season going to end at? I think most people are thinking maybe around 1.6 TCF, 1.7 TCF. That's on the lower end, so we'll see how that plays out. If we end it at those levels, then you're going to probably have gas having some support into summer and into the latter part of this year, but a little bit too early. But again, volatility there. Now, as far as equities, I mean, I think today we're seeing the S&P is down 1%. Over the last couple of days, you've had, and within that, tech is down 3%, and tech is down around 4 or 5% here over the last 5 trading days. And so tech year to date is the worst performing sector. And, we've talked about why that is. And the best performing sectors continue to be cyclical sectors, energy, industrials, metals. And we've already talked about the volatility there. And so seems to be a subtle shift right now from these growth tech, AI type of growthy sectors to more cyclical sectors. I don't know if that's going to be, something that's going to, endure for the next 6 months or anything like that, but that's what's going on right now. And so it's creating a lot of volatility in equity markets. And so, the last thing I would probably want to talk about is, sort of energy equities, right? We always end on that. We're in the thick of earnings season. We've had several refiners. We've had most U.S. major oil companies, the big 3 service companies. I've already reported generally the earnings were pretty good. The outlooks were pretty good. Most people talking about sort of first half is, going to be probably under some pressure. Second half looks better. We're going to see a lot more companies reporting this week, service companies, E&P companies, refiners, the whole gamut. So it's going to be really interesting to see what they say and how the stocks react. And so that's kind of about it, Maynard. We're really looking forward to Jim. Like you said, Jim's an old friend. We're looking forward to basically hearing what he has to say about the electricity sector. He's an expert in this area, and so we're hoping that he'll have a real good show today, and hopefully our listeners will be educated and learn something from this podcast.
Fantastic. Well, Deborah, it's Always a thrill to have you. Thank you for joining us. Anything on your mind before we jump in with Jim?
Well, I think to your point, the volatility is interesting. It seems like we've forgotten that winter does get cold, and so maybe some of the traders have forgotten that. But I'm excited to have this power conversation. I think it's incredibly complicated, and having this type of dialogue is really important. So we can kind of get away from these broad brush, oh, this is the cause, no, this is the cause, and really look at all the factors that are driving, power costs, whether it's demand or it's replacement of old infrastructure. And then we can make real decisions that are grounded in data.
Awesome. Well, I'm glad, Jim, I'm glad that Deborah prompted me, because I think this will be the second conversation we've had in the last few weeks around power costs, power systems, power dynamics. And as you and I've talked, we could probably have 10 more. And maybe we'll do that. We'll just make this a series. But power is a complicated topic. We're used to the oil and gas land, where oil price is pretty visible and gas price is pretty visible. And it's just not that way in power. But it's a long way of saying thank you for joining. We're excited to talk about this. And I might start with the first question, which is, as Mike was going through all that volatility stuff, this up, this down, this backwards, this forwards, you manage capital, you see it every day. How are you managing in this volatile world?
Well, the vast majority of our portfolio are regulated monopolies in pipelines and in power. And so while the share prices are volatile to some degree, I mean, utilities are clearly less volatile than other things, but they bounce around a lot. But their earnings are as stable as you're going to find in the market, because what we invest in are monopolies that operate on a cost plus revenue system. They've been granted that monopoly in return for that cost plus system. So they can only earn a certain amount on their invested capital. But I think one of the things that's going on is a rotation towards value and a rotation from large to small cap, and that's been benefiting the broader energy sector, because it certainly is a much lower PE than the S&P as a whole. What's interesting is the themes that ricochet through the market. And I mean, today the theme was enterprise software is dead. So like Salesforce and FactSet and any company that has a business model like that is going to be disrupted by AI. So AI is at the center of all this. I think people are realizing that there's a lot of knock-on effects to this, one of which is we need more power. Power means you build machinery. And so the tech industry isn't just about smart people sitting at a keyboard programming code. It is now about actually building large machines that move information and get power to those machines that move information.
Jim, do you mind commenting just a bit? You've had a really interesting career. You went to Harvard, you got an energy planning degree, you started at BP, you were at Sanford Bernstein doing research, you ended up going to Tiger, and then you founded your own firm. I was thinking, as I asked you the volatility question, it was a little bit like you said, yeah, I handle it by staying in things which are less volatile. But maybe just talk about your career and some of the key ingredients in your background.
Yeah, so I started my career in 1982 when the energy sector was 47, that's 47% of S&P earnings and 27% of S&P market cap. And the world had decided that we were running out of natural resources in general and energy in particular. So 1982 was a pretty deep recession, as people may remember who were that old. And because I focused on energy, I had a number of job offers.
Yeah.
And I took the job at BP. It was actually the old Standard Oil Company of Ohio, because they had recently finished the Alaska pipeline, which meant they they had to hold back on expenses and hiring during the construction of that. But once it started, they had a lot of cash flow, so they were out hiring a bunch of people. And what was fortunate for me, in 8 years, I had 7 different jobs of increased responsibility, because of just that imbalance between cash flow and headcount. And so that that experience, I was in the downstream business, and the chemicals business. I got a lot of experience in different parts of the business other than just, or sorry, with the exception of oil and gas drilling. And it, I got to Sanford Bernstein because their approach to hiring analysts was to hire them from industry so that they would have sort of a research edge on everybody else whose training was mostly just financial and spreadsheets. And so that is how I kind of went. So I got to the energy industry because I was fortunate to have focused on that in graduate school, and that was the industry that was booming. And then that is what got me to Wall Street.
It's a slight segue, and forgive me, Mike, because you've been around the research industry more than I have. I've just been an admirer. But Sanford Bernstein always did seem to have some key ingredients in the stew, which made it a really good research firm. And then in today's world, we often think there's that somehow that industry has lost a little bit of its cachet as an industry. I'm just curious to pause on that for a minute and see if you have any reflections on that firm and how to have a really good research firm.
So the primary thing, and the reason because I had my last job at BP, they moved me to New York. I was sort of BP's man in New York. And I started getting recruited by Wall Street, and I knew I didn't want to do investment banking because I didn't want to work 120 hours a week. I had a family. And what I liked about Sanford Bernstein as a research shop was they were not attached to a bigger Wall Street firm where the analysts were under pressure to be kind to the companies that were investment banking clients. We didn't have that conflict of interest. We were truly independent. And so my quip back then was that, on all of Wall Street, there were 20 sell recommendations. 10 of them are at Bernstein and 5 of them are mine. And that really wasn't that big of an exaggeration. It was kind of a soundbite, but it really was true. I mean, I launched on the refining companies in the early 90s. I think there were 3 or 4 of them, and I launched on all of them with sell recommendations. And so people are like, who launches on something where you're telling people to sell it? One of the companies objected to my research and, called the research director, and the way they handled it was just terrific. They stood by me, and he says, looks good research. We think it's solid, and let's stay friends, because there may come a time when your stock is cheap and we're going to be your only friend. And that was exactly what happened 2 or 3 years later when we recommended them again, and we were the only people doing that. And Bernstein, I thought, did a terrific job of navigating that tension between an analyst that has a sell recommendation on a company and the management team that may not like it.
And then when you began, you and your partners started Energy Income Partners. Did you go right to regulated utilities and pipelines as your focus, or has that evolved over time?
No, that was the focus of EIP. But before that, between Tiger Management and EIP, I did a long short hedge fund that was very similar to what I was doing at Tiger. So it was commodity related industries, and so we would trade commodities, but mostly we were dealing with equities, and we were long short, and so we had a tool by being short to deal with the volatility of commodity and basic industry companies, and and navigated it extremely well. I mean, our investment universe was down over the 5 years that we did that, and we were up like 50%, and our universe was down 10 to 30%, depending on how you wanted to weight the different components of it. but running a hedge fund like that, you never have your eyes off the screen. You can kind of never go on vacation without your laptop. And we got some inbound requests to invest alongside what me and my partners were doing in pipelines and similar utilities. And a lot of them were formed as income trusts in Canada or publicly traded partnerships in the U.S. And so they really weren't institutional type investments. And at that time, the internet bubble had burst. People wanted real assets. They wanted dividends as evidence that the companies had free cash flow. And that's how the firm got started. It was inbound requests to invest alongside of us.
Well, that was obviously just before you started EIP as Enron and all of those issues. You just
people kind of said it was like the anti-Enron. I mean, Enron was making their money on the trading desk, and we were making our money collecting dividends from pipeline and utility companies. It was really boring stuff.
So you just referenced it. Doesn't come up a ton, but we found it interesting. A couple of weeks ago, we were at the CIBC conference for a few days. We saw some of these Canadian utilities that sometimes own, U.S. LDCs and things like that. Do you do U.S. and Canada, or what are the geographic boundaries of your fund?
We're global, but as it turns out, most of our investment opportunities are in North America. So we have owned Canadian utilities in the past. You're right. I mean, there's cross-border stuff there. There's two of them in particular. I'm down here in Naples, Florida, and the natural gas here is delivered by Tampa Electric, which is owned by Emera, which is a Canadian, utility holding company. There are some opportunities overseas. But what you find is the cyclical parts of the business are within the same company as the cost plus stable parts of the business. And so we tend to avoid those. And so there are a handful, literally less than 10 stocks overseas that have the attributes that we look for. And we have owned probably 5 of those 10 in our 22-year history.
So I was you replay this in early 03, and this history 10 times better than we will, but the world has changed so much as it relates to power in the last 4, 5, 6 years. But in the early 2000s, this was the period when we're building a lot of natural gas plants. People had turbines on back order. You had that whole dynamic, warehousing them. Somewhere in there pretty soon you had some bankruptcies. Like, it was just you can describe it better than us, but do you mind just kind of describing over your EIP's history some of the big ebbs and flows in power? A little history lesson?
They were really big. And to understand why we had that build out, you had to understand, why the margins were expanded. So that investment cycle occurred right after we created deregulated markets for wholesale electricity. Because prior to that, going all the way back to the turn of the 20th century, meaning 1900, all power was generated by cost plus vertically integrated utilities that were regulated at the state level. And what happened in the 1970s and 80s were massive cost overruns in nuclear power. And in a cost plus system, most of those costs got passed along. And I was head of business development for refining and marketing for the whole U.S. for BP in the middle 1980s. We were running economics on making our own power at our Lima and Toledo, Ohio refineries, which were the largest customers of Ohio Edison. And they were charging us, after these cost pass-throughs, 6 cents a kilowatt hour, and we could make it ourselves for 3 cents a kilowatt hour. So we were going to cut the cord, and we weren't the only ones. And that meant the fixed costs of the system, which back then were probably at least 50% of the cost. Today it's about 80. Was going to be divided by fewer and fewer and fewer kilowatt hours. And so something had to be done, and deregulation was it. Now, in addition to passing along the costs, they disallowed a lot of the costs. And so the utilities were like, look, I'm in a cost plus system. I thought that's what the deal was. We didn't do anything wrong. We had cost overruns. They weren't our fault. If you're going to not allow our investments to get a return, well, we're just going to stop investing. And so they did. And of course, demand for electricity eventually started growing again after the energy crisis of 79, 80. And it was met with no incremental supply to speak of because the utilities had sort of folded their, taken their ball and gone away. And so after 10 or 15 years of that, you're now in the early 90s. And so what's happening is deregulation is finally legally and legislatively set up. Because remember, the challenge is that all the poles and wires are still owned by state regulated monopolies. And so providing open access to a merchant power generator by somebody who controls a monopoly and may have some of their own power that they want to favor over an independent producer, that took a lot of legislation, the setting up of regional transmission organizations, et cetera. But by the early 90s, all of that was in place. And of course, margins are high for those guys because we just went 10 or 15 years without adding capacity. And that was how Enron was so easily able to manipulate power prices by making a phone call and saying, hey, I think this power plant's going down. What do you think? Spreading a rumor, and people, got law on the power, and, all of a sudden the price goes up, right? Because they're threatening, to close a plant, or there's a rumor about closing a plant. And that kind of manipulation doesn't work unless the supply-demand balance is very tight. So, the coal plants are big and dirty. We were going through the Clean Air Act amendments. No one wanted to do that. Nuclear power plants, we had the cost overruns. No one wanted to do that. And so natural gas was the solution as it is today. And the thing was, natural gas generation was the high cost way of making electricity then. The existing coal plants, the existing nuclear power plants were cheaper. So all of these folks like Calpine that built all these plants and said they had a cost advantage, they might have had a cost advantage against a similar gas generation machine, but they were all at a disadvantage relative to coal and nuclear. And of course, they overbuilt, borrowed too much money, and that resulted in all of those, I don't want to say bankruptcies, but financial distress across the merchant part of the system that left in place surplus natural gas capacity where the utilization rate was in the high 30s or the low 40s just 10 to 15 years ago. So when we started building wind and solar in scale, and which are intermittent, of course, and we needed natural gas to back them up, well, we had this whole fleet of underutilized natural gas plants to do that. Those utilization rates are now in the mid to upper 60s, which is full capacity essentially for them because of the seasonality of demand. And so that is where we are today. And, understanding that history going all the way back to the 1970s to understand how each cycle came about and the causes for it, and therefore perhaps what the fixes might be, I think are pretty important. And that's what's missing. And Deborah said it right off the bat. It is much more complicated than people who write newspaper articles are allowing. And the solutions that are being proposed very often don't make sense because they don't reflect the underlying reality of how we got here.
To follow up on that, I mean, that's a great history. I think a lot of people don't understand that we went through this whole period of very limited capital investment. But you talked a lot about generation, but the time period you're talking about, 70s to now, that's a long period of time. And you've got distribution and transmission that also needed to be upgraded. And as we are now facing with this very unprecedented uptick in demand, which I think the industry didn't really anticipate, that has to factor in. And I think that was some of the things that you've been writing about, which I found fascinating. So a lot of people aren't focused on that. Everybody's talking about the tailgate, right, where the electrons are coming, but it doesn't really help unless it gets to the end consumer.
Yeah, and when you go back to that, my story back in the mid 80s when wholesale prices had gone to 6 cents a kilowatt hour, residential prices were probably 9 cents. So 2/3 of the cost back then to a residential customer was the power and 1/3 was delivery. Those have completely flipped. And so deregulation, I mean, pretty much the wholesale price of power today is still about 6 cents. I mean, at the plant gate. And so adjusted for inflation, which is 3.3x since then, wholesale price of electricity adjusted for inflation are down by 2/3 over the last 40 years. So deregulation by that measure was an overwhelming success. And you can't really have deregulation in monopoly poles and wires. And so those costs have kind of grown with inflation. And that's why they are now 2/3 of what residential customers are paying. The average residential rate in the United States today is 17.5 cents. And the generation charge, which sort of starts at one of these hundreds and hundreds of trading nodes that we have in the United States, on average, according to the DOE, in 2025 was about 7.5 cents. So, 10 of the 17 cents is actually the delivery of the electricity, and it grows with inflation, much less the amount of capital we have to put in to upgrade the system.
So Jim, those pieces, and we'll attach, you've written a few papers here recently, Power Struggle 1, Power Struggle 2. If you don't mind, we'll attach these as when we send out the podcast. Power Struggle 1, you talk about the three buckets: the generation, the transmission, and the distribution. And you really point to bucket 3 is where there's been the most, and I think you'll explain it better, but you're talking about the country. You've looked at the states, but you've looked at the country and said, look, the biggest price run up has happened in the distribution bucket. Do you want to start with that and talk about why you think that bucket has gone up, and what is in that bucket? And is that bucket always the same, depending on where you live?
Yeah, great. That's exactly how I would have phrased the question. So again, we get to 17.5 cents, by starting at 7.5 cents for the generation, adding like 1.5 cents for the transmission. And transmission is defined in the industry by above a certain voltage. So a little electricity 101. If you remember, maybe people have seen the movie, the current wars, right? There was this battle between direct current, advocated by Thomas Edison, and alternating current by Westinghouse. And alternating current had the advantage that you can step up the voltage, which has the advantage of reducing the cost of moving it over long distances. So you boost the voltage way up, you put it in these wires that are like 100 feet in the air, right? You see them all around Houston, especially along railroad rights of way, way above all the trees. And then you step that voltage down in about 2 or 3 steps to get it to the voltage that comes to your house or a business. And then the last mile or two is distribution, and that's what is averaging today about 8 cents a kilowatt hour, 8 of the 17.
And Jim, just so everybody knows, we're talking about average retail
for the country.
For
average residential.
Residential.
Yeah,
right.
I'm glad you mentioned that. In the industry, they talk about retail. There are 3 main segments: industrial, commercial, and residential. When the industry talks about retail, they're talking about, on average, what those 3 customer categories pay. Whereas when you and I talk retail, we think of an individual going in to buy, something in a store. So in electricity, we have to use the word residential to distinguish between that sector and commercial and industrial. So since the political pressure and all of the reason that the public is reading about this is on the residential side, Power Struggle 1 was about explaining that. And so the political debate was what was causing this. And as you said, everyone was arguing about the generation. Is it renewables causing it? And the renewable folks say, well, even without subsidies, we're the low cost. And then the retort to that was, well, maybe, but we have to have all this natural gas to back you up. And we have to run these really long wires because utility scale wind and solar is hundreds of miles from metro areas where people live. So we, society, have to build natural gas plants to back you up, which is true because we ran through that surplus capacity that we had from the early 90s. And when you look at so much of the transmission being built out, it's connecting utility scale wind and solar which are in rural areas, in many cases, hundreds of miles from the metro centers where all the demand is. And so you say, okay, well, in the last 10 years, residential rates are up 4.5 cents, from 13 cents a kilowatt hour to 17.5. And even if 100% of the increase in generation over that time and 100% of the increase in transmission cost over that time was attributable to backing up and hooking up far away wind and solar, it would explain only 1.5 of the 4.5 cent increase that residential customers on average in the US have experienced. And so people were, so 100% of the argument was about 35% of the increase in residential rates over the last 10 years. And so then we said, okay, well, let's talk about this distribution portion. You know, what drives it? And it's like, well, the distribution portion is the last mile, is really where the utilities have so much of their capital tied up, other than generation. If they're in a vertically integrated state, or if they're in a deregulated state, they're only allowed to run the poles and wires. And so you say that's where, so the linemen, you know, extremely well-trained, expensive, you know, guys usually driving around in very expensive trucks. That's where, you know, fixing, you know, wires where trees had fallen on them in a storm. That's where that comes in. That's where accounting comes in. That's where the legal comes in. That's where customer service comes in. That's where property taxes come in. That's where income taxes come in. And so all of that tends to get thrown into that last mile or two on the distribution category. And so it's much more vulnerable to labor cost inflation, because power generation and transmission, which runs way above the trees, has a very, very low labor content to it. And so then what you find is that there is this 95% correlation between the distribution costs of the different states and that state's cost of living index. Now, there's anomalies by state. So in our analysis, we group things into deciles. So we have, you know, 10 deciles of 5 states, and we did a little scatter plot, and that the correlation between what residential rates are between the states to the cost of living in that state was 95%.
So does that mean, Jim, and I came in this weekend, I brought my power bill just so I'd have it handy. And it has some line items I need to ask everybody about. But my question was really seriously going to be, so let's take California and Texas, just for fun. Your argument or your paper would say, of those 3 buckets in those 2 states, the first 2 buckets are pretty similar. The difference in the power cost is in bucket 3.
Yeah, generally, it really is. There is a higher cost of generation in California, and when we compare Texas to anyone, what we find is Texas is the low end of the range. Whether we're looking just
all in,
and in generation, and so there is an uplift there. Even so, when you look at what industrial customers pay, which is effectively, you know, very close to a wholesale price, you know, California is not only higher like 5-10 years ago than Texas, it has grown faster than Texas. And you know, that's a result of cost of living. It's a result of the fact that as inflationary increases happen on the fixed costs, California's demand isn't growing. And so the denominator is actually getting smaller when we take all these costs and divide by kilowatt hours, and that's the calculation to charge people. We have much better arithmetic in Texas, where demand is growing, than in California, where it was shrinking.
So that's a fascinating piece right there, the growth piece, and how that affects because I think people walk around, I'll plead guilty to saying, well, you know, Texas, it's about 20 cents, and California, it's in the 40s, and New York, it's in the 40s, and you kind of do this quick thing. But the fact that part of the problem is in one instance you're benefiting from a growing base, and in another instance you're being hurt by utilization matters.
So.
Yeah, that's really fascinating.
You said something really interesting. So maybe two pieces. One is you were talking about renewables as a generation, and it's kind of out in rural areas, and there is additional cost both to backstop the intermittency, but also to get it to where the customer is using it. So longer distances. So that adds some costs. And if you were comparing that sort of on a per unit basis for generation, that would likely is higher on a full system cost than say if you dropped a natural gas plant close to a city center. So that's one issue. But the other one that you mentioned, which I should have thought about that as an accountant, but the distribution cost, when you say distribution, most people think, oh, it's that last mile, it's the pole top, it's, tree cutting, and the guy that comes in and reads the meter, or if you have a smart meter, it's all of that infrastructure. But you're saying it also includes really the customer storm, if there's a storm and the wires go down, the dispatch of that all is in distribution as well.
It is.
Including all upgrades. The whole industry has been going through an upgrade, smart meters, better customer service, better your app to be able to read that takes additional investment. And that's a customer experience that's positive. So that's all lumped into your distribution number. It's not just hard infrastructure.
That's exactly right, because it's, the DOE gives us that data in those buckets. Sometimes, and I went and downloaded a number of utility bills from different states, and there's a wide range in the granularity. Like in Connecticut, for example, bills went up a lot because they were accumulating bad debt through, and then COVID happens. And now that account like quadruples. It's like over $1 billion for a small state like Connecticut. And then finally they said, we have to pass this through. And so they add this whole extra category to the customer's bill called public benefits. And then that has a few categories in it. And then the public is going, what the heck is this? But since that's not generation and that's not transmission, it gets thrown into that third bucket, even though it's not distribution per se. It's really everything other than generation and transmission.
So Jim, it seems like that's a big number because you said that's the biggest component that has increased.
Yep.
So I'm a residential customer. That's the piece that I'm seeing. Does it seem like from a policy, like as a voter, shouldn't we know what pieces of that is driving that, so that maybe we can talk about these trade-offs,
it's just
get
like,
a better.
But it's just like companies when they deal with analysts on Wall Street. Sometimes they keep things close to their vest, and that bites them, because if it's something out there that's not their fault, they haven't given Wall Street the granularity to show it's not their fault, that it was an exogenous variable. But likewise, when you show granularity, the things that are your fault are right there for everybody to see. So you can understand the political tension of doing that. And in Connecticut, what they wanted to do, because the costs went up, was itemize them to say, look, these are things that aren't so much out of our control, but things that we as a state have decided to pay for. And so don't think it's just electricity. There are all these other things. And the regulated utilities have acted as sort of a policy tool for decades, where you can provide public benefits without raising taxes. And since pretty much all the taxpayers all buy electricity, it ends up falling to the same people. The trouble is when you put things on a per kilowatt hour basis, it's a regressive tax, not a progressive tax like income tax rates.
Yeah, Jim, you've talked a bit about market structure between regulated and deregulated market impact on prices. I think the biggest issue that I see out there in markets right now, and we've been at these EEI conferences, is this: what is the cost of data centers coming onto the grid? I think most people, most residential customers, most people in the U.S. would say these data centers are just, they're overloading the system, they're driving up prices. The politicians are saying that as well. Maybe go ahead and tell us your point of view, because I think it's really interesting. You have an interesting point of view. I think it would basically calm down a lot of people that think that, bring your own generation to market is a good or bad thing, depending on the structure you're in. Maybe talk a little bit about that.
Yeah, so I talked about this in the piece called Power Struggle 2, which we published about a week ago. So we go back to that history of deregulation. We have deregulated wholesale markets everywhere in every state. But at that time in the 90s, the states made a choice. And 35 states today made the following choice. They said, look, this industry started off as a vertically integrated cost plus monopoly. We're going to keep it that way in our state. Now, we can't keep deregulated markets out. We may have our utility buy power from somebody else if it's cheap. But commodity markets are inherently cyclical, which creates, financial distress, which can lead to reliability issues. It can lead to safety issues. And if you look at the history of the railroads in the 1800s, it is basically a playbook of what goes wrong in a cyclical commodity infrastructure business. And so those states we call vertically integrated, but they're a cost plus system. 15 states today, plus the District of Columbia, chose not to do that. They said, no, we want the efficiency of the market playing out, and that'll help consumers. And as I quoted the wholesale prices, before, deregulation really was a positive competitive force. So when people write about power prices and they don't distinguish between these two systems, between these two groups of states, they're missing the most important dynamic. So in a deregulated state, it's a cyclical commodity business where if demand goes up faster than supply, the price goes up. If that were to happen in copper or aluminum, no one would think that is front page news. Of course, in a commodity market, if demand goes up faster than supply, the price goes up. That is what triggers incentives for new supply. But when it happens in electric power, people are confused because they use the word utility to describe the power generators in those states. They are not utilities. They are independent or merchant power producers that operate just like, Alcoa or Phelps Dodge Copper, selling a commodity into a market. And so when you look at what has happened to wholesale prices, and we use industrial customers here rather than those locational nodes, because they're actual real customers and their average price is only about a penny above what the DOE says the average price is at those trading nodes. And remember, most of the trading, like 80 to 90% of the trading at those nodes, is between the merchant power generator and the utility, not an end customer. So when you graph out the experience of wholesale prices as measured by industrial customers over the last, call it, 8 or 9 years, the two different systems were kind of going along the same. And only 3 or 4 years ago, when power demand started rising again, have they diverged. So in vertically integrated states, industrial prices are essentially flat over the last 4 years. They're up maybe 0.5 cent, depending on where you pick the starting point. In the deregulated states, they're up about 3 cents. And so there is and you'll see the graph in our piece, it is a stark difference in outcomes, but it shouldn't surprise anyone because, of course, if you're still shutting down coal plants at a time when demand is rising, of course the price is going to go up in a deregulated commodity market. But in a cost plus system, it's the average cost of all the fixed cost, all that labor we talked about before, and the cost of the power generation that you have built over the last 30 or 40 years. Nothing that's happening today affects that cost calculation, except volume. And so only one utility so far has sort of figured out how to communicate this to the public. And AES did this at the EEI conference in November, and they put out a slide and they said, look, we have a vertically integrated cost plus business in Indiana, which is a vertically integrated, non-deregulated state. And they had a graph with 4 lines on it. The base case, where and their average electricity price in their state is 15 cents. And it's going up to like 16 and a half with inflation over the next sort of, 7 to 10 years in this graph. And then they had 3 other lines, low, medium, and high data center demand. And the more data center demand they had, the more the price went down because the denominator was growing faster than the costs. And that is the essential dynamic in a vertically integrated cost plus state, where the dynamic in a deregulated state is prices are set on the margin. And if incremental capacity is more expensive than what you put in 5 years ago, 10 years ago, that's going to set the price for all the electrons, because that's how commodity markets work. The marginal cost sets the price. In vertically integrated states, the average cost divided by volume sets the price.
Man, that was a casserole of power stuff in there, Jim. I was thinking a couple of things to ask you as you think about this. One is, think about this. Sometimes you just notice that when you say regulated states, you could be talking about two very different states. That's just one thing I noticed. Like, I don't know, you could be talking about Georgia and Massachusetts, but they're very different. So that's just one question or observation. Yep. The second one is, and because we're, sitting here in Texas, we probably get the Texas economic development on the brain, but it has felt like, because Texas had, generally speaking, lower prices, it was drawing activity. And then we have a deregulated market, which is responding to that. So in a little way, it becomes circular, like deregulation is drawing growth. Maybe think about that one. And then I guess my third question was, does the deregulated system, in your opinion, it might respond quicker, but do costs go down on the other side? Like, is it zigzagging around a regulated line, which is perhaps just moving slower but more constant? So now I hit you with too much back.
The cost plus model failed in the 70s and 80s because of the cost overruns, right? And Deborah alluded to this about the costs that are in the transmission system. And so let's talk about the incentive to control costs, right? And so let's talk about the incentives of those two systems. In deregulated markets, you got to remember, after 15 years of lack of profitability, the merchant power industry is now highly concentrated into a handful of players, and their shareholders have a gun to their head that says, if you even reach for your wallet to build a merchant power plant without a long-term contract, I am pulling this trigger. It's a Luca Brasi moment. On the other hand, in a vertically integrated state, the shareholders are like, what can you do to grow your investment base? Because I earn an allowed rate of return, and the faster you grow your investment base, the faster my earnings grow, right? So when you sit with these companies, their first two slides in their investor deck is how fast they're growing their investor base. Okay, their investment base upon which they earn that allowed rate of return. So you have two entirely different incentives right now. That one wants to grow capacity because it grows earnings. The other doesn't want to grow capacity because it'll shave the margin peaks that we're now enjoying. So when you look, there's all these websites that have real-time wholesale prices. And over the last week, when it was really cold, those wholesale prices, which are normally sort of 5 cents a kilowatt hour, were like 20 cents, 30 cents, 60 cents. And that's because, the cold weather was creating sort of all this demand. Those merchant power guys make over 100% of their profits in less than 10% of the time when those prices spike. Because between the spikes, they're pretty much just recovering their operating costs. So they're not incentivized to add capacity. Why else did Texas have Prop 7 2 years ago that created a $10 billion incentive fund for companies to construct what the industry calls dispatchable, always available power, as opposed to intermittent, which is what wind and solar are? And effectively, since no one's going to build a nuclear or coal plant anytime soon, even in Texas, it's natural gas. And so now what you have is the White House pushing the hyperscalers, the big tech guys, to write long-term contracts with power generators, because they're not going to build power generation without them. In a vertically integrated state, they don't need a contract. They get cost recovery. sort of automatically, so long as they're building something that the Public Utility Commission signed off on. And they're not going to build a new plant without agreement from the Public Utility Commission. And they may argue after it's built if there were cost overruns, whose fault that was. But at the end of the day, you don't have that investment recovery risk in vertically integrated states. And so now that's why you see the hyperscalers going essentially to vertically integrated states. The biggest deal signed to date was in Louisiana between Meta and the state regulated utility there that goes by the name of Entergy. And it is phase one is 2.3 gigawatts. By the time it's all done, it'll be 4.5 gigawatts. To give you an idea, that 4.5 gigawatts represents nearly 40% of Louisiana's current demand. 40%, like a 40% increase in Louisiana electricity demand from a single campus that if it fills out the way Meta thinks it's going to do, is going to consume 4.5 gigawatts of power, all fired by combined cycle, base load natural gas capacity built by Entergy. And again,
and maybe while we're on that,
the hyperscalers want to be associated with pushing prices down. In a deregulated state, they have to worry that they are the cause of pushing prices up.
Yeah, I was wondering while we're on that, because Mike just referenced it. Let's go through. I'm in Louisiana. I'm a citizen. I'm not Meta. I've got 4 gigawatts are going to be built. Why do I not need to be worried that my power bill is going up?
Because the denominator is going up so much. That's why AES did that graph. And Entergy will tell you that they have communicated in certain ways in Mississippi, where they're also getting more volume in Louisiana, that all else equal, people's bills will go down 15%. Now, there's inflation over that time that could offset that. Natural gas prices could go up to offset that, but all else equal, the effect of growing the denominator by that amount is pushing residential prices down.
But do you think when the administration is saying we want the hyperscalers to sign separate deals and do behind the power and build it all themselves, even in a place like PJM, are they just worried about the optics of what people think is going to happen to their power, or do they, like, what do you think about the administration intervening like that?
So the people in the administration, and we know a few of them. I mean, the secretary, the kind of effectively the number two person at DOE is a guy named Alex Fitzsimmons, who was recently, he's now the acting undersecretary of energy for what they call energy. But his prior position was head essentially of cybersecurity and reliability. This person is singularly focused on the system crashing and avoiding it. This administration is hypersensitive to any blackouts, especially going into the midterm elections. And so that is why you have these orders to keep these coal plants open, to give some cushion to the system. So the White House is motivated, as is every governor of every state, like Josh Shapiro in Pennsylvania. They're motivated to make sure that first the lights don't go out. Yes, it's bad that residential prices are going up, but what would be worse is if the lights go out. And so somebody in the industry had a conversation with the secretary and other folks to say, look, we're not going to build anything without a contract. And so in essence, really the White House is acting as a mouthpiece to say, we're talking to both sides. We see the friction here. And so now we're telling the hyperscalers to step up. To some degree, they already are. I mean, Microsoft signed this multi-year deal with Constellation to bring back that unit at 3 Mile Island that was shut about 4 or 5 years ago. And they signed a contract at about 12 cents a kilowatt hour, 2 times the wholesale price, to give the economic incentive to Constellation to be able to do that. And we've had similar deals now announced in Ohio and in Illinois, where those deals sort of put a floor under the margins for the merchant power producers and provide incentives to actually incrementally expand those nuclear power plants. So the hyperscalers are already doing it with nuclear. I think the administration is trying to nudge them and have them do it also with natural gas. The difference is that natural gas input cost is highly cyclical, much more so than, say, uranium. And it's a much bigger part of the price you need to recover than uranium is in a nuclear power plant.
I mean, from a policy perspective, the argument makes sense, right? Because the hyperscalers are the ones driving a lot of incremental demand. You don't want to socialize that cost over the long term just to the residential customers. You're saying, hey, if we need to socialize this cost and maybe skew that back to the people that are driving that. And so the follow on to that is there is, and maybe you've been following this as well. I mean, there is quite a bit of evidence. You talked about natural gas, certainly the most available in terms of the timeframes that the hyperscalers and data centers are looking to deploy and sort of capture this whole AI boom. But a lot of evidence that you're getting what I'll just call a behind the meter, and it becomes sort of a shadow fleet that's out there. There's generation capacity that's getting built. Do you have a sense of how big that is and whether you talked about reliability? Because it's really affordability and reliability. Lights go out, nobody's going to worry that you kept the prices low. So how much of that could also be beneficial if that could then be used as a future system asset to keep sort of that backup reserve build down a little bit, if you could kind of marry those two?
Well, that's the key word there is backup. So we have to get a little more granularity on behind the meter. For the most part, the hyperscalers do not want to have power behind the meter. They want to be hooked up to the grid, and they want the reliability that comes from that, and they want what the industry calls ancillary services, which is essentially making sure the voltage and the frequency of the power is where it's supposed to be. So again, a little electricity 101. We operate on an alternating current system. That current alternates from positive to negative 60 times a second because the machine is spinning at 3,600 RPM. 3,600 divided by 60 seconds a minute is 60 cycles per second. When we have rolling blackouts, it's not that the machinery can't produce 97, 96% of what's demanded. What happens when demand exceeds supply in a very quick way is the machinery is stressed and that frequency drops below 60. And it is the analogy I give is in the old days when you would hand crank a car and it started up, people sometimes broke their arm. It was called a Ford fracture. Think of a spinning system connected to a power grid that is spinning in the exact same cycle, and what it's selling electricity to, and all of a sudden is slowing down. You can literally shear the armature of that generation unit. And so they shut the system down to protect the equipment, because once you shear the armature, you're throwing that machine away. It's not like you're going to bring a guy in and he's going to fix it in a few hours. And so the voltage and the frequency has to be maintained. The grid has this massive inertia, and the hyperscalers want to be hooked to that. Having said that, there isn't a data center being built going forward that doesn't have its own backup power. And that backup power is generally reciprocating diesel or natural gas engines made by Caterpillar, Cummins, or Wärtsilä, which is a Finnish company. And they will be able to run some portion of their data center, maybe 100%, if the grid goes down. And states are now negotiating with them saying, yes, it's great you're putting in backup power. Some states may mandate it, but states like Texas passed last year what's known as Senate Bill 7, where they said, we are going to shut you off. We're not going to call you and ask you and discuss it for 5 minutes. We are shutting you off. So if you're a large load customer like a data center and the system is stressed like it was just a few days ago, if we need the power that you're consuming, we're shutting you off. Now, if you want to keep running, then run your backup generators. If you're not going to run, what we would like you to do is run those backup generators and have that feed into the grid. And so the energy secretary last week issued an order for the various states and regional transmission organizations to have their backup generation available to the grid. So again, in discussions, you had a gentleman on the COBT a couple of months ago named Tom Popick. He created a foundation that singularly focused on grid reliability, and I introduced him to some people at the DOE. And what they found they had in common was this knowledge that we have probably 100 gigawatts, 10% of our dispatchable generation capacity. Dispatchable means always available, so nuclear, coal, natural gas. There's another 10% scattered across the entire countryside at factories and data centers of mostly reciprocating, internal combustion diesel engines that could provide a backup. The trouble is how many thousands of phone calls have to be made in 5 minutes to be able to access this. But it is a resource that this administration is working on, so that it's there to help the grid. And there are air regulations that make it very difficult for those units to run if the blackout isn't in their area. So it's almost impossible for them to turn on to help the grid in general if the blackout is happening 200 miles away. They could help it if they would run, but the air regs say they're not allowed to. So there's actually proposed rules being presented to the EPA to change those rules. But the backup power is everything. So again, one of the things I don't know if I said it before, but the utilization rate of the power generation system in this country is 41%, and that takes out wind and solar. And you say, well, how can we have these rolling blackouts when the utilization rate is 41%? And the answer is because in the peak time of year, which for the country is late July, early August because of air conditioning, and south of the Mason-Dixon line where you use heat pumps, there's 2 peaks a year, kind of now, the late January, early February, and late January, early August. And the demand for the country at those times is 105% more than at the trough. And that would be the shoulder months of April and October, where you aren't really heating and you aren't really air conditioning. But that's the country on average. There's places where that ratio was 1.3 to 1, 1.4 to 1. And so if you think, okay, I need to have excess capacity for that period of time, I have to have 140% of the generation as I have at the trough, you can see why the average utilization rate is so low. And the Energy Secretary actually referred to this when he spoke to CNBC at the Goldman conference a couple of weeks ago, I guess it is now, saying, look, we have a peaking problem, much more than we have a supply problem. So we have to be intelligent how it is that we shave those peaks, because that alone would allow us to, serve more data centers on this build out. And so there is base load power and there's backup power, but it's the unevenness of electricity demand that creates the stress times that we're going through just this last 2 weeks, and we will go through again in late July and early August.
So Jim, this has been awesome. And I'm so glad you mentioned Tom at Resilient Societies, because that was fascinating. We'll attach that episode that's part of this whole series. I was just thinking as we wrap up with you, maybe some of your key messages, and we'll all try to do this together. One message is, of the 3 big buckets of power costs, generation, transmission, and other.
Yeah.
That third bucket is where we need to look when we're thinking about costs going up. And we should probably stop talking as much as we do about generation sources. We should probably stop talking as much as we do about transmission costs. We should probably stop pointing the finger at data centers as being the robber barons that are going to mess this whole thing up. And we should be, and I love what Deborah said, but we should be focused on reliability, because, I mean, you said it great. Like, if the costs go down and the power goes out, like, who cares? So that is a big piece of this, and you can't talk about these things without talking about reliability. What did I miss when you think about
That's
your key messages?
that's the key message. And then how are we going to, you know, what can policy do to make sure that sort of the normal incentives of people trying to make a profit on their invested capital is either encouraged on the one hand, or the friction that prevents it from coming through on the other is not being caused by people in state houses or in Washington.
Can I ask you one last question, Jim, that drives me crazy? So literally, when you look at my power bill, which I've started studying a little bit more these last few years, you get this thing which says, you know, your energy charge is this many kilowatt hours at, 21 cents a kilowatt hour is what mine is. And then there's a surcharge for transmission distribution. There's gross receipt tax reimbursement. There's a bunch of line items, and then you get the total. So from the energy charge to the total charge, you get, it looks like another 5+% on the bill. Are all these things, when you compare across states and across bills and across buckets, is everybody doing it the same way?
No, they use different names in different categories. So a lot of times the word energy means just the generation part. So in Connecticut, it's a very granular bill. And so you know what you're paying for generation, which by the time it comes to Connecticut is already 9 cents, even though the DOE would say it's 7, because that's what the generator who's selling it gets. And then the utility is buying it for 9 because it has to move a little bit. And then they tack on transmission, and then they tack on distribution, and they tack on public benefits like, covering for the folks that couldn't, afford to pay their bill, or, the extra cost of the offshore wind, or any other sort of, energy or environmental program that they're doing at the state level. And sometimes they itemize those, and sometimes, I'm talking about across the states, and sometimes they don't. And Florida, there's almost no granularity. I mean, there's like 3 lines. Connecticut has like 10 or 15 lines.
So keep thinking about this power price reliability convention we might have. And I think our first requirement is everybody's got to bring their power bill.
Yeah, it'd be fun, because you're right there. I mean, you understand the optics of it. Sometimes you want to share what the detail is to show that it's not your fault, and in other cases, you show more detail on it is your fault. They're going to see it. But one of the messages that we've had, and we've submitted testimony to the Federal Energy Regulatory Commission twice on this, is to provide the utilities an incentive to reduce their operating costs. So remember, in a cost plus system, they add their operating costs, their interest on debt, and their allowed rate of return. That's their total cost, operating plus capital costs, or operating plus financing costs. Divide that by kilowatt hours, and that's the price people pay per unit. But how about if you let them keep some of the cost savings from cutting operating costs for 5 years, and their allowed rate of return would actually go up a little bit, but the bill would go down, because remember, the operating cost, they don't have any incentive to save operating costs.
It's
other
great.
than the fact that the Public Utility Commission is going to yell at them and maybe disallow this or disallow that. But how about just giving them a plain old profit incentive to cut costs?
There's a lot of stick to keep for that, but there's no kind of carrot for driving efficiencies.
Remember in the 92 presidential debates, Ross Perot said, I solved the deficit. I'll solve that overnight. I'll just put those congressmen on commission. You keep 10% of everything you don't spend.
People respond to incentives. It's not like they're dumb. It's not like they're immoral. They're doing exactly what just 99% of human beings would do in the exact same situation. So change the incentives.
Jim, this has been awesome. We really appreciate you, and want to keep visiting and debating and thinking and chewing on all this with you. Really greatly appreciate it. And thanks again for getting us Tom. We really greatly enjoyed his stat about, I think he said 1,000+ gigawatts of dispatchable power in the country. And I think we're sitting on 100 gigawatts of backup diesel. that is a great stat. So
Yes. And
good
Tom,
guy.
Tom, I mean, you think I'm a geek with the numbers. I mean, it's a contest when he and I speak on who's the bigger geek, but
Number speaks to where the value we place on reliability.
It's big.
It's big.
Big.
So,
Deborah, that's a really great point. I think there isn't enough discussion about that. In Florida here, Florida Power and Light does a great job of recovering from hurricanes. They actually have a university for utility CEOs to learn how they do it here in Florida. But part of the environment here is both Florida Power and Light and the State House in Tallahassee know exactly what it costs when the Florida Power and Light footprint is down for a day because of a hurricane. It's $1 billion. Everybody knows that number. And so when you think about investing $100 million, that would eliminate that day. The payback is 10x in the first year. Now, maybe it wouldn't be that cheap to be able to avoid the outage for a day, but you get the idea. If you invest capital that keeps the system up, the beneficiary is GDP. If you're a merchant power producer, you don't capture that benefit. If you're a state-regulated utility where all the costs are socialized, you do. And so you can see why different decisions can be made in a vertically integrated state versus a deregulated state.
Jim, we appreciate you. Mike, Deborah, thank you. This was awesome. Jim, appreciate you, sir. Fantastic.
Thanks for having me on.
Absolutely. Thanks, everybody.